Todd Mitchell here. In our last video, you discovered one of the most powerful phenomena in trading, the intersection between two primal forces of the market. It's been the source of wealth for many of the world's wealthiest fund managers, including titans like Paul Tudor Jones, who pocketed $4.7 billion thanks to it. I'm talking about the high velocity alignments. On January 27th, 2016, an alignment struck in TLT, the US long bond ETF. What happened next is nothing short of amazing. Despite being one of the most liquid and highly traded ETFs in the world, with over 1 billion in average daily trading volume and representing the 11 trillion US Treasury bond market, once the alignment occurred, shares in the ETF promptly soared 4.94% by February 10th. TLT call options were up 124.57% in the same window. A mere $1,000 investment would have paid out $1,245 in profit in only 14 days. Again, in video number 1, you learned a bit about how these high velocity alignments work. My partner Roger explained that it takes 3 things to spot them: a stock with a very strong uptrend, a short-term pullback from the main trend, and a signal from the slingshot telling us to get in. When you get all 3, you'll wind up with opportunities like this. In late April 2016, Tyson Foods traded down to $62.61 per share. It had just experienced a sharp pullback from its highly bullish long-term trend. Then, on April 22nd, the slingshot signaled a trade entry. By May 9th, the stock had popped up to $70.40 for a 12.44% gain. TSN call options, on the other hand, were up 259.71%. On every $1,000, you'd have earned $2,597 on the trade. Now, these trade examples I'm sharing are not random, isolated anomalies. We spotted 58 alignments in 2016 and a further 6 so far in 2017. Our model portfolio shows a historical accuracy of 71.88%, with average returns of 134% on our winners, while only losing 45% on our losers. If you'd invested $1,000 in all 64 positions, you'd have earned $53,540 in profit. With a $10,000 investment, you'd be looking at a life-changing $535,400. Now, those numbers are incredibly impressive. In fact, they're stunning. But I have to stress, you need all 3 factors working in your favor to earn anything close to them. When you don't, it can get very ugly very fast. I'll let Roger explain.
Thanks, Todd. If you're watching right now, you need to listen closely. At this point in our 4-part video series, you know just enough about high velocity alignments to be dangerous. The risk is that you'll take the facts I've shared so far and apply them in ways that will only devastate your portfolio. I see this happen all the time. A trader gets their hands on a fancy new indicator, they pick a stock or security at random to use it. Maybe they're a big fan of Apple or Tesla or Starbucks, so they pile it on without any real analysis. During the Snapchat IPO, a horde of social media addicted millennials bought the stock at its peak. Within days, they were all deeply underwater on the trade. Maybe they targeted a stock simply because the price dipped, or a short-term indicator signaled a buy, and they were confident that they were getting it at a discount. Investing like that is a recipe for disaster. Instead of capturing powerful, high-velocity alignments like this one, when a trade was triggered in NetEase on May 10th, kicking off an 11.26% pop in just 6 days, with a 109% gain in the NTES call option position, which could have doubled your money on every dollar invested in under a week. You risk getting trapped in brutal situations like this, where a pullback turned into a full reversal, sending Alphabet tumbling $44 per share. Or this, where a good entry on one indicator failed, sending Nvidia crashing by as much as $20 per share. Mistakes like that have led to some of the worst trading errors of all time. You start with a single misstep. You buy into a correction, let's say. Then maybe you start buying more and more to rescue your position. That's what happened to Nick Leeson at Barings Bank. He allowed a $2 million loss to explode into $827 million. That was $1.4 billion US dollars at the time. When his losses were discovered, he drove the bank into bankruptcy. You might have even seen the story in a movie called Rogue Trader. Why do these tragic errors happen so often? Typically, it's because investors have ignored the most important of the two primal forces guiding the markets, the long-term trend. You might have heard this line before, the trend is your friend. It's a bit of a cliche, but it's also very true. A strong long-term trend is the best foundation for low-risk, high-reward trading. With a powerful long-term trend in your favor, you get higher accuracy. More of your trades win out and fewer miss. You also tend to get bigger wins and smaller losses. Plus, when you catch that incredible moment of alignment, when the short-term trend intersects with the powerful underlying current, the results, as we've already seen, are explosive. You get high-velocity alignments like this one on CBOE Holdings. On January 12th, when the alignment triggered, it was at $72.71. Literally, just 2 weeks later, it had popped to $77.11. CBOE call options we identified delivered a 148.48% return. That's enough to turn $2,000 into $4,969.60. So the question is, how do you find stocks with the strongest long-term trends? There are dozens of ways to identify a stock's trend. Most of them don't do what they're supposed to. I've only found one system that works consistently, the velocity protocol. The protocol is broken down into two major steps. Step 1. Identify the stocks with the most long-term momentum. Step 2. Confirm that the short-term trend on those stocks is still strong. You see, a pullback always jeopardizes the main trend. It weakens it temporarily. If the trend was already weakened before the pullback, it increases the odds of a reversal. These techniques help protect us from the danger. They increase our odds of a pullback, sparking a high-velocity alignment. In June 2016, there was a pullback in Nvidia. It was a velocity protocol target stock. Sure enough, on June 30th, 2016, an alignment was triggered. By July 12th, it was up 14.03%. Nvidia call options we identified were up 79.15%. In less than 2 weeks, a $1,000 investment would have paid $791. With step 1 of the protocol, the key ingredient is momentum. Momentum, momentum, momentum. Unlike other popular indicators, the price momentum of a stock actually predicts future price moves. It's been demonstrated in countless historic backtests. The decades that I've spent in the market prove it. If a stock is soaring north, it'll typically keep soaring. So to find the stocks in the strongest uptrends, we need to find momentum. We measure that with something called relative strength. And no, you shouldn't confuse this with RSI, another popular indicator. This approach is very different from anything you've traded with or seen from the so-called trading gurus out there. Basically, we calculate the strength of a stock's price compared to others over 30, 60, 90, and 200-day periods. When a stock's price momentum outranks all others in the market, it becomes one of our trading targets. You're looking at a relative strength comparison of 3 stocks. They are Micron Technology, Intel, and Lam Research. Notice the 6-month return for Micron was 37%. For 3 months, it was 21%. And for 1 month, it was 9%. Notice that Micron outperforms the other 2 stocks over the same period. As far as relative strength, There's no doubt that Micron is the leader. We'd focus on it in our hunt for profitable pullback opportunities. Of course, we don't just look at 3 stocks in a single sector. Every 2 weeks, I perform a relative strength analysis on the entire stock market. Out of thousands of stocks, I identify a basket of high momentum targets. These are the stocks with the strongest long-term trends. They're the ones that should give us the safest, most profitable entries. Like this high velocity alignment on Time Warner Cable. In February 2016, it was on the Velocity Protocol watch list. As you can see, it had enormous amount of long-term momentum. Then on February 9th, an alignment struck. Within 8 days, it was up 5.39%, while Time Warner Cable call options were up 174.13%. A $1,000 investment would have returned $1,741 in profit. Of course, all trends eventually come to an end. Even the strongest stocks with the most momentum will stumble. There's always a risk that short-term weakness could trigger a dangerous reversal. That's why we filter our list even further with step 2 of the Velocity Protocol. I mentioned this in video 1, but I'll say it again. The short-term trend is often at odds with the long-term trend. You can have a stock with a lot of momentum over 30, 60, 90, and 200-day windows, but with low, no, or even negative momentum over a short time frame. If the short-term trend in a stock is weak right before a pullback, watch out. It could be a beginning of a major reversal of the long-term trend. That's why we only focus on stocks with short-term strength. We measure that with an indicator called ADX. It stands for Average Directional Index. How it works is a bit complicated. It measures something called directional volatility. The important thing for you to know is that ADX tells you the strength of the trend in a stock over the last 5 to 10 trading days. If ADX gives us a green light on a stock, we can spot trades like this one in SVXY. In March 2016, it passed both our relative strength and ADX tests. On March 9th, an alignment was triggered in the ETF. By March 22nd, shares were up 21.01%. That's a huge move for such a short window of time. SVXY call options were again up even more, with a 58.6% return. That's a $586 profit on every $1,000 if you take in the trade. That's what happens when you get an ADX green light. But if you skip this part of the Velocity Protocol, or if ADX gives us a red light on a stock, you risk stumbling into a painful reversal, like this one on Hope Bancorp. ADX warned us about the short-term trend. Then the pullback happened. Sure enough, the long-term trend rolled over. The stock dropped all the way to $18.57, way below our entry. That's why we remove any ADX red light stocks from our list. What we have left is our final set of targets. Now we wait for a pullback. Again, it's not just as simple as buying the dip. Remember how I warned you earlier that you knew just enough to be dangerous? Well, you've learned a lot today, but you still don't have all the pieces of the puzzle. Even with our list of Velocity Protocol targets, there are still serious risks that could derail everything. For example, you can get pullbacks that are too weak, where the stock drifts down slowly, and it doesn't have the tension to snap back to the main trend. So instead of a profitable high velocity alignment, you get a stubborn sideways plateau. On August 3rd, the Nasdaq Biotech ETF peaked at $298. It began to slowly sink lower over the next few weeks. Then it drifted sideways over the next few months. It's simply not a profit opportunity. You also get pullbacks that are way too strong. We're looking at a chart of Amazon. It peaks above $840. Then we enter a sharp pullback. The correction is so sharp, it breaks the main trend. Now the stock is in a free fall, plunging all the way down to $739. Again, it's not a profit opportunity for us. In scenarios like that, you risk becoming another cautionary tale, just like Nick Leeson. And maybe you won't lose $1.4 billion, but you absolutely can vaporize your entire portfolio. The good news is that there's a solution, a way to avoid the risk of too weak or too strong pullbacks. It's with the unique technical indicator we've hinted at already, the slingshot pattern. When you spot this in any pullback, a high velocity alignment is about to strike. On February 3rd, it triggered for Deere & Company. You can see the indicator dipping down into the high velocity zone. Notice how it immediately explodes with an 8.34% gain by February 18th. And just 15 days after the slingshot fired, DE call options were up 103.17%. That's enough to double every dollar you invested in the trade. $1,000 would have become $2,000. $5,000 would have become $10,000, all in precisely 15 days or half a month. Obviously, that's impressive. What's more impressive is this. Every single trade we've shared so far was predicted with just two simple tools, the velocity protocol and the slingshot pattern. Today you've learned how the first one works. In our next video, you'll get all the facts behind the second.
Keep in mind, in just the last 64 slingshot alignments, 71.88% of them have ended in profit. If you'd invested $1,000 in all 64 positions, you'd have earned $53,540 in profit. With a $10,000 investment, you'd be looking at a life-changing $535,400. Now let's look at that another way. If you've got a $10,000 portfolio, and if you'd invested 10% of your capital in each trade, you'd have earned $47,849 in 2016, or a one-year return of 478%. With returns like that, $10,000 would potentially be $334,084 in 2 years. After 3 years, it could potentially be over $1.9 million. And let's look at one more way. Let's say you aren't investing for growth. You'd be investing for income. With $50,000, investing $5,000 per trade, you'd have earned $289,000 in those last 64 trades. That's more than most doctors make. The key to all this is the slingshot. So keep an eye on your inbox for your next video link. It will be arriving tomorrow.